Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. All right, great to be able to catch up with you and really have a longer formatted discussion, which I think is helpful really for viewers to kind of understand what's going on in the market. So thanks for joining us.
My pleasure, Catherine. It's great to be with you.
Thank you. When I look at the markets right now, I feel like, we were hitting new highs, we're grinding higher, but there's a nervousness about valuations. Everything's priced to perfection, if not higher than that. Maybe slower, lower growth, maybe inflation fears, maybe a Fed tapering that can jitter the markets. And then, of course, the COVID variant, which is perhaps slowing down the economic recovery, but at the same time, it almost lends itself to a longer economic cycle. That's kind of how I'm viewing the world. And therefore, you have to ask yourself, okay, well, what do I want to do here? But let's start with your macro view. What are you thinking these days?
Yeah, I think you highlighted definitely a lot of the, I think, important topics that are on people's mind. I think what's interesting is, all of those things are occurring. So yes, we're at all-time highs. Growth is slowing. There is uncertainty about what the economic backdrop is. I mean, we have an election in Canada. You have the central bank potentially tapering in the U.S. In an imminent way potentially. And so there's kind of a variety of risks that are out there, and markets are at all-time highs, and you're entering a seasonally weaker time of year. So for all of those reasons, we've looked at the market, and where we've now raised a bit of cash in the last month because we can check all of our risk boxes off and say it doesn't look like much of this is being priced in to where markets are at all-time highs. And so it's not to say that the market should go down imminently or we expect it to, but I think we're just viewing the fact that we're entering a weak time of year. It's probably healthy to take some money off the table here. We've definitely recycled a lot of our positions under the hood. So, a lot of our more cyclically exposed names that had really run in the first half of the year, our view come the end of summer was that the growth rate of the economy was about to start slowing. And so we wanted to start taking some of that stuff off. So we've recycled some of that into more defensive parts of the portfolio. So, the overall cash levels are a little bit higher than they were, a few months ago. But I would say what we own in the portfolio has changed pretty significantly in the last couple of months. And that is with the view of saying we're probably going to slow down here into the fall, and let's be a little bit more defensive given how much the market has run so far from the beginning of the year.
So, question then, in terms of taking some profits, I mean, and maybe you've kind of answered it in terms of recycling that money. But I think, one of the struggles that investors have is you might own a great name like an Apple or a Google, and, you're well off your average cost base. The question is, how much of that do you sell? I mean, do you sell the whole position? Do you sell half of it? How do you go about thinking?
Yeah, I think that's a question that a lot of investors do struggle with. And I think the way that, if I could simplify it down, is it comes down to, firstly, what is your position size as your overall portfolio? And, and then the second thing would be, is there a taxability or tax event if you're going to sell? And then, how much confidence or conviction do you have that that stock is imminently going to go down? So, I think a lot of people, on the retail side, my bet from some of the portfolios that I've seen when people come into Avenue is that people have, significant position sizes in certain stocks that they've owned for a very long time, and they haven't sold them, and stocks have done well. Like I've named Apple and Amazon, or Google and Amazon, even for that matter. And so the question is just, what is an appropriate size of someone's portfolio should any one individual stock be? And that's, up to individual investors to kind of decide what they think is best. We certainly care about valuation, and things that get to be a little bit too rich for us, we have no problem selling. But taking, like, let's just say you have Apple in a portfolio and it's a 3% weight, and to sell some down to a 2% weight, is that really going to impact the overall portfolio? Probably not. And so we would rather wait for that company to start either being far too expensive or doing something that we don't like. And we would rather make the decision, let's just sell the whole position outright and use that money for something else. That's not to say if you have a position that becomes 5 or 6 or 10% of your portfolio because it goes up a lot, of course, at some point you should harvest some of that. But I think where we're trying to not be too cute is taking things from 3% to 2%, because in the overall portfolio, that's not really going to have a huge impact. We would rather own full positions in things that we really like than kind of tinker around, because it just adds to the turnover of the portfolio, if that makes
Got
sense.
it. Yeah. So from a short-term then aspect, you do think that there could be some seasonal headwinds. But where do you think we are in the longer-term cycle?
Yeah,
whatever that means.
Yeah, I think what's so fascinating about the last year and a half now, going back to last February, March, is that the way I would characterize this is that we've been in a global economy as a whole, but for this conversation we can sort of key on Canada and the US. We've been in a debt trap since 2008, 2009, and where policymakers have taken us is to even more fiscal stimulus and even more central bank asset purchases and intervention. So, and the question this time around was it going to work? And I think what's clear is that with current debt levels, doing even more fiscal stimulus based on government debt is really not helping the economy in any kind of a sustainable way anymore. And so we can go out and borrow a lot of money. So, the US has borrowed $5 trillion in the last year and a half. Canada is over 400 billion. So both are 25% of GDP that we've borrowed. And so, as citizens or market investors, what have we got from that? We've got 2 quarters of pretty good growth, but what's clear is the economy is already stalling out. So the question is, what should we do versus what will policymakers do, and how do you invest around that? So, I think the first thing we should do is we should stop really. It's going to be come from a different angle, but I think continuing to do fiscal stimulus based on debt at this level of debt in the economy is making the economy worse off. So when you're in a hole, the first thing you should stop digging. But do I think that they're going to do that? No, I think we're going to continue with more stimulus. You're already seeing that, in the US. It looks like they'll likely pass a bill through reconciliation by the end of the year. So we'll be seeing more fiscal stimulus in the US potentially. And then in Canada, we're running an election where pretty much every party is saying they're going to borrow more money to do more things. So the stimulus will continue. And so I think as investors, what's important is to not think about what should happen, but think about what is most likely to happen, what is happening, and how should you invest around that. And that's kind of core to how we're viewing the world right now. But at the end of the day, even regardless if we're going to do more stimulus and governments are going to borrow more money, our expectation is that the economy won't be better off, and that in 6 months' time or a year's time, we'll be facing the same dilemma where the question is going to be what's next. And so this game can keep going, and at some point it will stop. And I think the other side of the coin is really central banks keeping interest rates low to allow governments to be able to afford all this debt. You've now created all kinds of different asset bubbles. And so, stocks are up, housing's up, which is making everyone feel wealthy and people are going out and spending money. But at some point, this kind of bizarre, almost Alice in Wonderland world that we're in is going to stop. And the question is, A, when will it stop? And I don't think anyone will know. And I think, 2, the question is, how do you invest in this world? But most importantly, how do you protect against this on the other side? And that's kind of how we're thinking of it, if I were to frame sort of the overall picture of where we are.
Right. And what do you think? What have been some of the solutions to that dilemma, really? Right? I mean, it is a bit of a Goldilocks world. Rates lower for longer. It's been the case. It's been supportive of asset prices, i.e., continue to own your equity markets. But there's asset bubbles likely in many, many areas, and everybody always thinks that they're diversified, and that aspects of their portfolio are uncorrelated, and that's just never true when something happens. And that's the question: when does something happen that readjusts the prices of all these various asset classes? And we don't know when. You said that, and I totally agree. We're always trying to figure out what we need to be looking at and watching for to figure that out. But in the absence of that, how do you protect clients' money?
Yeah, so it's a great question. I think, and the way I would also frame this, this is sort of the way I think about it, is that it's almost like investors, we're playing like 3 games of chess all at the same time. So I think of this as sort of 3-dimensional chess. So there's game 1 is you're playing the game of chess with your portfolio and what you own. So do you own good companies? Do you own bad companies? Do you take profits? Do you raise cash? What are you doing on an individual company basis? If you move over to the second chessboard, that's the macroeconomic backdrop. And so, what are interest rates doing? What are debt levels doing? Are there any bubbles that are clearly evident, and what do I do to protect it? And then I would say, increasingly what we're moving into is a world where there's a third chessboard, and that is what is the government and sort of social response of people in a country. So it's kind of like there's 3 boards, and on each board there's different opportunities and then there's different risks. And so I think most investors spend a lot of their time on the first board, focusing on the companies and what they own. I think more and more of my time I'm spending on the second board, which is sort of the macro backdrop, and really assessing the risks that are out there. Because in this world where everything has been pushed up because interest rates have been so low, what that means is when things reverse, correlations everywhere go to 1. So you can think you're diversified being in a long equity portfolio, or being long real estate, or long credit. It's all the same at the end of the day, and correlations will go to 1 if you have some kind of a macro event or a shock to the system. And so one of the things that we've done in the last year and a half is we've implemented a sliver of our portfolio that we have in what we call the avenue tail protection portfolio. And so our equity portfolio is 98% invested in stocks, and 2% of our sliver of the avenue tail protection portfolio. And what that allows us to do is, in that sliver of a portfolio, we're able to protect against significant declines in the equity market. Well, at the same time, the rest of the portfolio is fully invested in companies that we know and like. And so for from our perspective, I think traditional diversification has been sold as you have to be 60-40 or 70-30 stocks to bonds. And I would say that that traditional diversification effect is not what it used to be. If there were to be a significant decline in markets, I mean, I'm sure long-term bonds and gold probably do well relatively, but it's not about doing relatively well if everything's going down. And so you need something in your portfolio that can actually go up to protect against the rest of the portfolio. And so that's what we've done in the last year, and we think that we're doing everything we can to sort of be able to play both chessboards at the same time. So we're focusing on the companies we own, but we know we have our tail risk protection to protect against the second and third boards, which are going to be increasingly, I think a part of where markets are going and the economies are going heading forward.
And so, sorry, what do you use to protect then? Are you doing put strategies or what?
Yeah, so there's certain things that we buy. We go into the derivative space with that small, very very small sliver of the portfolio, and what that allows us to do is to own a derivative instruments that provide convex asymmetric payoffs if the market were to crash. We do this over very short-term periods, and so what it allows us to do is get the most bang for the buck of protection. Where if we were to say we thought the market was going to come off and we wanted to move half the portfolio into bonds. Firstly, you have to be perfectly right on timing. And then at the same time, the bonds don't provide enough of a payoff to protect against the rest of the portfolio. So there's certain segments of the derivatives market where you can get that protection and the cost to the overall portfolio is very low.
Give us an example as to what that would be.
Yeah, so a simple way to think of it would be thinking of it like buying out of the money puts on a stock index is a way to think about it, and then laddering them out in an appropriate way, and then having the rest of the portfolio invested in diversified companies. That would be the simplest way to think about it.
Okay, and just so our viewers really understand what a put strategy means, buying out of the money puts, basically if the market goes down, you make money on that directional trade. You believe if you're buying puts, you're buying protection to the downside, and that should compensate for the loss that you're actually getting on your equity portfolio.
Yeah, exactly right. I think the important thing to highlight is the way options work are, it's, for example, if you were to buy a 2-month put on the S&P right now, 30% out of the money. So you take the S&P's at 4,500 and you were to buy, let's say a 3,000 strike. The options market is pricing in that option has a 0% probability of being in the money. So, and what's the probability of the market going down that much in the next month? I'd say it's very low, but it's not zero. And so the difference between zero and what the option market gives you and where options go, if the market does reset, that's what gives you that asymmetric payoff. So that, and the most important thing is you don't need a large part of your portfolio to use to protect it. The problem is if you're using 5 or 10% of your portfolio to protect, then the rest of your portfolio in good times is suffering that underinvestment. And so because out of the money puts give you such an asymmetric payoff, short-term puts, you can do that with a very small part of the portfolio, and then the rest of the portfolio can continue to grow in good times.
And so given the fact that the options market, as you just described, is assigning a 0% probability to the market going down 30%, and I agree, it's probably not zero, maybe it's 1%. But I'm wondering, the pricing of those options, are they, somewhat affordable? And the reason why I'm asking this, not affordable, but like low cost, because, most options do expire worthless. You're doing this for protection. You're not doing it necessarily to make money. But there is always a cost of the portfolio. So you have to be very mindful of the price. And even if they were priced high, but there was increased risk, you'd probably still buy them. So, but give us a sense in terms of the cost of the portfolio.
Yeah, so I think the easiest way to think of this as you want to have a defined budget at the beginning of the year for what percentage of the portfolio you're going to use to buy protection on the index. And so I guess I would also say, for anyone who thinks that the world is great and markets are going to continue to go up and everything's perfect in the economy, then, protecting the downside is not for you. That's not, but those certainly aren't, what our clients are feeling right now. And I think, the reason why we do this is because, we're aware and we can understand what risks are out there. And so it's about knowing your own tolerance for risk and then, having a strategy to protect against it. But sort of exactly to your point, what you're touching on, this is why, out of the money option strategy work, is because when you have tail events, there's always mispricing in the tails. And so, even if, let's just say, you're pricing something as there's a 1 basis point chance that the market goes down 20 or 30%. And even if it actually does go down, then that one basis point cost of probability is so low relative to the rest of the portfolio if you're using 10 basis points or 20 basis points of your portfolio. And so the payoff that you get from that small sliver more than compensates for the fact that most of the time you're not going to be right, the market's not going to go down, but the whole idea is, and the rest of the portfolio continues to benefit and go up. So it's really the two of them together. It's not, the tail protection as a standalone strategy. What matters is, if you're wanting to own tail protection, it's what are you protecting against? Are you protecting against the rest of your portfolio that's fully invested, or are you just betting on the market going down? Because we're certainly not betting on the market going down, but we want to protect against that. And at the same time, the rest of the portfolio then can be invested, and we can be comfortable with what we own. But it's really going back to the chessboard analogy. It's protecting against the systemic risks that are now on that second macroeconomic chessboard. And the only way to really do that is to do things through the derivatives market.
Yeah. Well, and I'm glad we talked about it, because I think a lot of the time, people talk about protecting their portfolio, but nobody really knows what that means. So.
I totally agree. It's such a jargony term. So no,
it is
fun to go under the hood.
Yeah. No, it's important. And I think that, for our viewers, when we, put this out online, we'll highlight the fact that we're talking about portfolio protection, because I think it is so key and critical. And the thing is, you only really hear about portfolio protection and somebody making, $2 billion off of it after the fact.
Yeah.
Right.
No, so I think the other thing too,
money doing this too.
The other thing too is that when a strategy like this will grab the headlines, will be, yes, in that crash event when everybody wants it. But the problem is most investors actually aren't disciplined enough to say, no, if you understand how this works, you actually want to have this all the time because of what it's protecting against. But it does take, the mental discipline, stamina to say, yeah, in good times, it's not going to provide a benefit, but it more than makes up for it when you actually need it. And so, that's why when you see the volatility go to 80, the volatility will come down and live at 15 because nobody's afraid anymore. But it's always, when vol is cheap, that's when strategies like this are able to provide the most bang for the buck in protecting your overall portfolio. But it's something that you'll see a headline and then 3 years later, you'll see another headline. But it's the discipline of having this through that period that I think most people aren't able to stomach.
Yeah, absolutely. I want to get to a couple of stocks as well, just in terms of, when we think about quality and names that you're comfortable with right now. And actually, before I get into that, we should talk a little bit about, when you think about government policies and, the risks that, are really being imposed around the world from central bankers and lower for longer interest rates and the debt accumulation. From a geographic perspective, what's your weighting as it relates to Canada and the United States?
Yeah, so we think of this, definitely, I would say we're North American investors, so we're, in many ways agnostic to where we place our money within North America, but we'll also, we'll be biased based on where we think there's relative opportunity or where there's better value than other places. And so we've lived the last couple of years around a quarter of the portfolio specifically directly in the US. At times it's been higher than that, at times it's been lower than that. And we at the same time, we own a lot of businesses that are listed in Canada that actually own assets in the US. So we think of it more in those terms of where is the ultimate asset owned and operate. And from that perspective, our portfolio is pretty close to half and half, Canada and the US, of where is the actual either asset or economic activity going on. Even though our US dollar exposure might be closer to a quarter of the portfolio. And I think, the challenging thing, I think, for many investors is they get really focused on what the currency is doing rather than, what is the relative investment opportunity. And a great example on this would have been, March 2020 or April of 2020, after the US market had really crashed lower, but the Canadian dollar was really weak. So for a Canadian investor to go in and buy US stocks, when the dollar was closer to, below 70 cents, the problem is your stocks have done well, but you've lost about 12% on the currency. So right. We think of it in those terms of, we don't want to take huge currency bets. That's certainly not what our expertise is, but we just want to not do extreme things when the market is at the opposite extreme level. So, when the Canadian dollar is really strong, we want to be looking outside. We want to be looking in the US. If the US dollar is really strong, we actually want to be looking at things in Canada, because then we can look at things when they're cheaper. And we just try not to get too caught up in what the currency is doing, on a daily, weekly, or monthly basis.
Okay. And I was thinking a little bit more on the election and policy risk front.
Yeah, I mean, that's a whole, we could probably do a whole show on that specifically,
Yeah.
but I think, I mean, yeah, I think what's important, and I've had to kind of park, certainly park my partisan hat the last several years because I realize in investing, it doesn't really help you. And I think investors really have to look through this in a nonpartisan way. And it really is just, what is a policy that is going to help the economy? What is policy that is not going to help the economy? And at the end of the day, is if our objective is to, have a prosperous economy where we can all benefit, then I think it's important for people to think about that. And to be honest, at this point, I mean, I'm really seeing every party just promise more things with borrowed money. And so the minutia of the policy, people can spend time, arguing about the difference. And it's certainly not, something I would do. But at the end of the day, I look at it across the board is that the government is going to borrow more money, spend more money into the economy. At the end of the day, I think governments continuing to borrow money is a huge part of the problem. So I'm not seeing a significant amount of solutions really from any party, and that might be my own view of it, but that's just kind of what I see, and I think it's clear that the economy is not responding well to more government debt.
Yeah.
But at the same time, going back to what we said at the beginning, I don't expect them to stop. So you have to kind of play the game that's in front of you. You can't hope that things get better.
Having said that, let's talk about a couple of stocks that you do feel comfortable owning right now. Cargojet. What's the valuation though on Cargojet these days?
Yeah, so Cargojet is the e-commerce air cargo delivery company. It's done very well. They're based out of the Hamilton Airport, flying all throughout Canada. And the thing with Cargojet that's I think was very interesting last year is this, 2020 the stock price doubled, but because earnings doubled or cash flow doubled, the valuation didn't expand. So you had a stock that went up 100%, but the valuation was still pretty reasonable. And in the last, so far this year, since January, the stock has kind of just moved sideways, and it sort of digested an equity issuance that they did earlier in the year, but it trades roughly around 11 times EBITDA. So it's not expensive relative to other parts of the market. I think some people look at the stock and say, well, this has really run a lot, I don't want to own it. But when we go under the hood and look through the operating performance of the business, we think it's in a great spot. It's very reasonable valuation. And I think that there is continued room for them to grow, not just in Canada, but also internationally as well. And so we're very comfortable owning it. It's the largest position in our portfolio. And we've trimmed it when it ran up. We added back to it when it sold off earlier this year. But we're still very happy owning that as kind of a long-term Canadian business.
Okay. And within the dental space, you like Dental Corp.
Yeah, so Dental Corp is a new one for us. They came public a few months ago on the TSX, and really what they're doing is buying up all the private dental offices throughout Canada. So there's about 15,000 dental practices in Canada. They own about 440 of them or so. So their share of the market is sort of low single digits. And dental practices have very stable cash flows. I think Canadian population is the most insured from a dental insurance perspective in the world. So about 80% of Canadians have dental insurance, and almost more than 90% go to the dentist at least once every 2 years. And so there's a real stable business underlying that. And what they're able to do is go in and acquire and roll up new dental practices, and it trades at a very reasonable valuation. And it's a just over 2 billion market cap, but we think this is something that there's a lot of room for them to continue to grow.
And the ticker there is DNTL. Do I have the right one?
DNTL, yeah, Dental Corp Holdings, I think is the name of it.
It's down pretty significantly.
Is it? What is it? What's it down today?
Well, sorry, just over the past. Let's see. I don't know, over the past. Well, from the highs, let's put it that way.
Well, I think it got up somewhere around $17. It probably went back down to about $15, and then.
Okay. You know what? I've got the wrong one. Okay, I'll bring it up. Okay, yeah, but
it's trading somewhere around 15.5, but I think it got issued at 10, went to 17, and then it's trading down there somewhere around 15.5.
Okay. Got it. And then lastly, Ann Lauer. What is that company?
Yeah, so Ann Lauer Healthcare Group, the ticker for that one is AND, and that trades on the Toronto Exchange as well. And what they do is healthcare logistics, and really thinking about it as the most sensitive sort of temperature controlled part of healthcare logistics and delivery. So for medications or vaccines that need to be stored at very particular regulated temperatures, they do all the transportation for that through Canada. We really like that because we think it's a growing business. We think that they are leaders in the space. We think the management team and the CEO, I think, is probably one of the best business operators in Canada. I think he's very underrated. He knows the business very well. They recently did an acquisition in the U.S. To grow some of their distribution capacity down there, and so it's a nice business with high 20% EBITDA margins. There's not a lot of competition. It's highly regulated, and it's an industry as a whole. Healthcare, pharmaceuticals growing at high single digits a year, and so for us, this is something that we can own in Canada that we think is a really nice business to have in the portfolio.
Mm-hmm. Okay. All right. It's been a great conversation. Thanks so much for it. I'm glad we're able to catch up on the long-term views, portfolio protection, key, and some stocks. So thanks so much.
My pleasure. It's been really nice chatting with you, Catherine.